Okay, in this second video, we'll wrap up taking a look at cash flow proformas, and we'll start with where we left off last time with this sheet here. So we've started with looking at potential gross income. That's all possible income you can get for a property. We subtract from that a vacancy allowance that recognizes that we may have some empty spaces in the building and not collect all of the possible money we could collect. We're going to add any other income we might collect and subtract out operating expenses to come up with this important line item called net operating income. From that, we will subtract out capital expenditures, and that gives us the property level cash flow. And finally, we'll add in any reversion proceeds, the net reversion proceeds. So that means whatever we have left after we sell the property and pay any expenses associated with selling. So that gives us the total unleveraged cash flows for the property. Unleveraged meaning we don't have any debt on it. If we had debt, we would have to do some other cash flows, include other cash flows, the interest and principal reductions, and then the principal pay down once we sell the building. But let's move on in the slideshow to the next slide here and look at rental income and just look at some examples of each of these things in turn. So there's a spreadsheet associated with this, and in the other video that I've attached, there's I guess a third video, the one where I walk through the pro forma, the spreadsheet rather. We're going to detail each of these line items. So right now I just want to talk through each of these assumptions and talk about what that means. So we have three spaces in the building, a 7,500 square foot, a 10,000 square foot, and a 12,500 square foot space. They each have leases with different rates. Xantham is paying $15 a square foot. Their lease is going to expire in 1 year. Ypsilanti is 10,000 square feet at $17 per square foot. It's going to expire in 3 years' time, so it has 3 years remaining on the life of that lease. And then Zephyr Holdings, 12,500 square feet at $18 per square foot. And that lease is going to last all 5 years of our 5-year projection. So frequently proformas are not just looking at a single year, but it's projecting cash flows from a property into the future. And in this case, we're ultimately moving towards a 5-year proforma where we're trying to estimate the cash flows from a property over the course of 5 years. So what is the potential gross income today? We would just take the sum of the products of the square feet and the rental rate. So for instance, Xantham Enterprises, because they're paying $7,500 square feet times $15, that's going to be $112,500. Ypsilanti's, they're paying 10,000 square feet times $17 a square foot, so that's going to be 170,000 square feet. And then Zephyr, we would just get the product again of the square feet and the rent per square foot. And then we're going to add up all of those numbers together, and we would come up with the potential gross income. There's no vacancy. We don't have any vacancy in this building. We're assuming that these three tenants take up everything. So that's going to be the potential gross income. Now, the effective gross income is going to be subtracting out a vacancy allowance. So if we assume a vacancy and a collection loss of 5%, we would just back out 5% of that total potential gross income to come up with the effective gross income. And if you look at the example spreadsheet and the video where I walk through the spreadsheet, you can see those things in action. You can see those calculations being made. One quick comment on this vacancy / collection loss. Frequently those two things will be lumped together. Vacancy is pretty straightforward. We have space that's empty. Collection loss is the fact that refers to the fact that some tenants don't pay their rent, so you may not be able to collect on the money that you're owed. So those two things together are basically reducing your rental income. You're not collecting rent either. There's no one there to pay you, or the tenant's there but they're not paying you. So it's effectively empty. All right, let's move on to the next slide here and talk about these market rents for the spaces. We're going to assume that each of these spaces could be leased today for $18.50, or in year one they're worth $18.50, and that rental rate is going to grow by 50 cents per square foot. That is to say, the market rates, the market for comparable spaces, those spaces would lease for $18.50 in the first year, $19 in the second year, $19.50 in the third year. We're going to assume that everyone signs 5-year leases, so that's not necessarily uncommon in the office world. So that's kind of our working assumption. We're doing a little office building here, and everybody's signing 5-year leases. So the question, what is the potential gross income for each of the next 5 years? And what is the effective gross income, assuming a 5% vacancy collection loss? Again, if you go to the video or look at the spreadsheet that's in the module, you can see these calculations being done. You can see the results and pick off those numbers. All right, let's move on to the next slide and take a look at some other income and expense information. So we're going to assume some other income for the building, one being sourced from a rooftop lease. We're going to assume $9,000 per year, and we're going to assume no increases in that. So a flat $9,000 per year for all 5 years. And in fact, we can even assume that it's going to go on beyond 5 years. Maybe we have a 10 or 15-year lease with a cell phone tower provider, and so they're going to be paying us this set amount for the indefinite future. We can also have storage income. In this case, we're assuming $2,500 per year. And then with the operating expenses, we have several assumptions here, a variety of numbers for these on a per year basis. And then we are going to further assume that those are going to increase with an inflation rate of 2.5% a year. So these expenses are going to get bigger as we move through years 1, 2, 3, 4, and 5 in our pro forma. The last expense here is the management fee. That's going to be a variable expense. It varies based on the income that we're collecting. 4% of total income is the expense. And so with these assumptions, we can determine the net operating income for all 5 years, years 1 through 5. And again, if you look through the video that goes through the spreadsheet, you can see that pro forma built, and you can get down to the NOI for years 1, 2, 3, 4, and 5. So the next thing, after we've got the operating cash flows for the property, we need to look at the capital expenditures. And I've given you a few assumptions here. We're going to replace a roof in year 3. The estimated cost is $45,000. We've got tenant improvements of $8 per square foot. Anytime that we do new or renewal leases, we're going to pay that amount. So there's two of these spaces in the building that are going to be rolling over, is the way you'd say it. They're going to have a renewed lease or a new tenant coming in. Either way, we're going to have 2 tenant improvement or 2 spaces to do TIs in. So in year 2, the Xanthem space, in year 4, the Ypsilanti space. Then leasing commissions. Anytime we sign a new lease, we're going to need to pay leasing commissions. We're going to assume here that we're going to pay 5% of the total rental payments for the tenant for all 5 years of their assumed lease. And you can see how that calculation works again by looking at the pro forma or the Excel spreadsheet video. So lastly, we can determine the property cash flow for years 1 through 5, and that's again done in that video that goes through the spreadsheet, so take a look at that. Finally, we're going to look at the reversion value for the property. We're going to assume that we can sell the property based on an exit cap rate of 7.25%. And we're going to use the year 5 NOI. So we're going to take the year 5 net operating income number, divide that by 0.0725, and that will give us the estimated value of the property, what we can sell it for. Now from that, we're going to deduct the legal and administrative costs of $50,000. We're going to deduct the selling commissions, and we're going to assume that that's 4% of the gross sales amount. And that will leave us with a net amount, a net sales proceeds amount. And we will use that as our very last and our very biggest cash flow. Finally, we'll put it all together and we can run some numbers on that. If we bought the building for $3 million, would we have reached an unlevered IRR of 12%? We can look at that as a calculation, and we will do that. And then what would be the most we would offer for this building based on a 12% required rate of return? So once we get all the cash flows for the building, we can start asking these kinds of questions. How much would we offer for a building? Or if we bought it for this much, what would our returns be, etc. So we're going to stop there, and I would encourage you to look through watch the Excel video, try to follow along, maybe even fill it in as you're watching me. That's going to be the best way to learn Excel, is to do it, not watch it. So I would encourage you to maybe have a split screen or have a second screen where you're going to be doing these things. Pause the video frequently and do the stuff that's in the video. So that's all for this, and I'll see you next time.